All right, here we go. One more week, week 5. Time to dive into risk and reward. I think you'll like this chapter. It's a fantastic discussion on stock markets and how to put risk and reward together. I've got some good examples for you that you can actually use in your own personal portfolio. Beyond that, we also have a little bit of calculation to do. So let's dig in. Without any further ado, we're going to do chapters 10, 11, and 12. And returns. Returns have two components. The first component is current income. Current income could be interest, which would be from a stock, from a bond, or a dividend, which could be from a stock. Capital gains, of course, or capital losses, as they were, that would be because you bought or sold something. You could have capital gains in both stocks and bonds. If you buy and sell, the difference between the two, if you made money, it's a gain. If you lose money, it's a loss. And of course, returns can be expressed in either dollar or percentage terms. Now, we're talking about the return over the holding period at this point. So the question is, you bought it and you had some dividends, maybe for the stock, and then you sold it. And the price you bought it for and the price you sold it for, that's either a capital gain or a capital loss. And of course, the dividends are income. So if we break that into two pieces, we can see that dollar returns are an initial investment. That's what we paid. And then we get two pieces coming off of it. We have the ending market value, which hopefully is higher than what we paid for it. On top of that, we may have dividends. Now, you may not have dividends. Some stocks don't pay a dividend. They put all the money back into the company, and that's fine. You would know that ahead of time, obviously. And a lot of people invest in companies that are going to plow all the money back into the company to grow faster for hopes of a bigger capital gain. So when we start to look at the formulas here, the dollar return equals the dividend plus the change in market value. So your dollar return, the amount of actual money that you walk away with, is if you add up all your dividends and then the change in market value. So the change in market value is you paid 100, it went up to 110. The change in market value would be the 10, and then maybe you collected a couple of dividends on top of that. That would be your return. Now, the percentage return is the dollar return divided by the beginning market value. The dollar return, remember, we got the little formula right above it, is the total of your dividends plus the total of your capital gains return. So whatever money you made on it or lost on it, divided by the initial investment is your return. On top of that, we can break it down further and turn it into yields. So the dividend yield plus the capital gains yield is your percentage yield or percentage return. So if you earn 2% in your dividend and you had a capital gains yield, in other words, the amount you paid for it minus the amount you gained the selling price minus the amount you paid for it divided by the amount you paid for it. The end minus beginning divided by beginning will give you your capital gains yield. If you just add the two, you'll get the total yield. So if it's a 2% dividend yield and your capital gains yield was 110 minus 100 divided by 100, that's 10 over 100 for 10%. It would be 2% for the dividend yield, 10% for the capital gains yield. You add the two together and you made 12%. So you can do it in dollar terms or you can do it in percentage terms. And that's just your holding period return. Doesn't matter how long you held it for, that would be the amount of return you'd get. So here's an example. Suppose you bought 100 shares for Walmart a year ago at $50. Over the last year, you've received $100 in dividends. That's $1 per share times 100 shares. At the end of the year, the stock sells for $60. How did you do? Well, quite well. You invested 50 times 100 for $5,000. At the end of the year, you sold the stock for $6,000 because it went up to 60 times 100, right? So the cash dividends of 100 are also part of it. They're additionally included. So your dollar gain was $1,100. That's $100 for the dividend plus the $1,000 in capital gains. If you take the $1,100 and divide by the amount of the initial investment, $5,000, you get a 22% return. So you had a good year, 22% on Walmart stock. The stock went up 10%, but you made, well, the stock went up more than that, I'm sorry. It went up $10 and 50%. It went up 20%, and you made 2% more than that because of the return on the dividends for 22%. I'm sorry, I didn't quite get that right. All right, so let's keep going. So you can look at it here in the chart. The dollar return is $1,100. The $100 is the dividend. The $6,000 is the return on the stock. And of course, you paid $5,000 out. So we have a return, the net return of $6,100 minus $5,000 is $1,100 divided by the $5,000 is a 22% return. And of course you break that into pieces, as I just said. There was 2% for the dividend. That's $1 on a $50 stock. That's a 2% return. And then the percentage return on the shares itself. The shares were 50. They went up $10. So that was a 10% or a 20% return on the shares. So you have 20% on the shares, 2% on the dividends. The combined is 22%. Or you could just do the math on the dollars, which, as you see here, is 1,100 divided by 5,000 would get you 22%. Either way, you get the same percentage return, and the dollar return is obvious. It's $1,100. You started the year with 5,000. You ended the year with 6,100. The dollar return was $1,100. So a few problems in this. It'll be a piece of cake to figure out. Let's keep going. There's more to be had in this section. Lots of good stuff.